world changing faster than ever? Global trade assumptions challenged.
Unpack Deglobalization to 2040.
Have you ever just, looked around and felt like the world is changing faster than ever? Like all those connections we took for granted, they're reconfiguring right in front of us. Things we always assumed about global trade, where stuff gets made, even how much things cost, it's all being challenged. Fundamentally.
Yeah, it really is a major shift.
Exactly. So today we're doing a deep dive into what we're calling Deglobalization 2025 to 2040, the great global reshuffle. For decades, it was all about more integration, super efficient supply chains.
The dominant mantra.
And
Yes,
it
now.
feels like a totally new chapter is starting. So our mission for you today is to unpack this massive shift. We want to look at why it's happening now, what it means for, everything from your smartphone to your dinner plate, and maybe sketch out what things could look like by 2040.
And the scale of this.
Yeah.
It's genuinely remarkable. The IMF, the International Monetary Fund, they basically said the whole economic order we've had since World War II is being reset. That's their word.
Reset. Wow.
Yeah. The old rules, they're under huge strain. And new ones are kind of being hammered out now, but there's a lot of uncertainty. This isn't just like a blip in trade figures. It's a fundamental rethink of how countries trade and invest. We're already seeing global trade growth slowing down, cross-border investment kind of flattening out.
Okay, so let's unpack why this is happening now. What are the big forces driving this? I mean, the sources we looked at point to a few key things converging. Maybe the most obvious one is just escalating geopolitical tensions, right? And this rise in protectionism.
It's definitely front and center.
You've all seen the headlines about the U.S.-China decoupling, the tariff wars, the export controls. And early in 2025, things really ramped up. The U.S. slapped on these sweeping tariffs 25%, even higher on imports from China, Mexico, Canada too, pushing overall U.S. tariffs to levels not seen since, the 1930s.
That's right. The Smoot-Hawley era, basically. And predictably, other countries hit back with their own tariffs, retaliation.
And the economic fallout.
Oh, it's undeniable. Look at the data. Trade sanctions are like 4 times more common now than in the 1990s. And protectionist measures tripled since just 2019.
Tripled. Wow.
Yeah, and the IMF is warning, look, if this geoeconomic fragmentation gets really bad, the world splitting into hostile economic blocs, it could slash long-run global output by up to 7%. That's over $7 trillion.
$7 trillion. Hard to even picture.
It is. And if technology also decouples, which seems to be happening, that loss could jump to maybe 8–12%. So the insight here isn't just about numbers dropping. It's like the world is repricing the value of global cooperation itself. For decades, we kind of externalized certain risks for the sake of efficiency. Now nations are being forced to internalize those costs again.
Right. But it's not just geopolitics, is it? What about the supply chains themselves? Companies are really rethinking their global footprints, aren't they? This whole push for resilience, for reshoring.
Absolutely. Yeah. That's the second big driver. COVID-19, the war in Ukraine. Those are huge wake-up calls. They just brutally exposed how fragile those super lean, just-in-time supply chains actually were.
Yeah, we all remember the shortages. PPE, semiconductors, cars, you name it. It really felt like things were breaking down.
Exactly. And that experience created this powerful never-again mindset in boardrooms and government offices. The priority shifted almost overnight, it felt like, from pure efficiency, lowest cost no matter what, to focusing on redundancy, security, reliability.
But that security comes at a price, doesn't it?
It does. It absolutely does. Economists figure these trends, reshoring, friendshoring, holding more inventory, have already added something like 1.7% to consumer price inflation on average since 2020.
Almost 2% inflation just from this shift.
Roughly, yeah. So the big question that raises is, are we, as consumers, as societies, willing to pay more for that feeling of security, for that resilience? This inflation, it's the real, tangible cost of choosing stability over just chasing the lowest possible price tag.
Okay, so we have geopolitics, supply chain worries. What else? Our sources mentioned something about technological nationalism. High tech seems really central to this whole story.
Oh, completely. It's right at the heart of the competition. Nations increasingly see having their own tech capabilities, especially in critical areas like semiconductors, AI, 5G, as vital for national security and economic competitiveness. It's a strategic imperative now.
And we see that in the huge investments being made, right? Like the U.S. GPS Act, that's $52 billion, plus another $280 billion in the Science and Innovation Act. And at the same time, restricting exports of the most advanced chips to China.
Precisely. And China's response, a massive $1.4 trillion plan to boost its own capabilities in these next-gen technologies, trying to cut its dependence on the West. But it's not just the U.S. and China.
Right, others are jumping in too.
Oh, yeah. Allies are in the race. South Korea's got a $450 billion plan for chip mating. The EU has its $43 billion CHIPS Act, aiming to double its global share of semiconductor production. What's really striking here is how this is creating almost competing tech spheres.
Like a digital divide, but between countries.
Sort of, yeah. Look at the investment flows. U.S.-China direct investment in the tech sector. It plummeted, down 96% between 2016 and 2023. Some people are calling it a technological iron curtain.
A technological iron curtain.
It really complicates global innovation, raises costs, and fundamentally rewires how these global tech supply chains work. It's moving away from collaboration towards, well, duplication and competition.
Okay, one more big force. Climate change and energy security. This one feels a bit paradoxical. Climate change is obviously a global threat needing global cooperation.
Right, it should be a globalizing force in theory.
But in practice, it also seems to be pushing countries apart, driving them to localize energy supplies, competing for resources.
Exactly. It's acting as a fragmenting force, too.
Yeah.
Think about Europe's experience after Russia invaded Ukraine in 2022. That painful lesson about relying too heavily on a single supplier for natural gas really hit home.
So countries are scrambling for energy independence.
They are. Accelerating investments in domestic renewables, building new LNG import terminals. But it goes beyond just traditional energy. The critical minerals needed for the green transition, lithium, cobalt, rare earths are being called the new oil.
The new oil, because they're essential and concentrated in a few places.
Precisely. Demand is forecast to triple by 2030, maybe quadruple by 2040 if we're serious about net zero goals. And this is sparking what they call resource nationalism. Countries like Indonesia banning exports of raw nickel ore, for example, to force companies to build processing plants locally.
So climate goals are actually driving protectionist trade policies.
In many cases, yes. It's fascinating. Climate change is absolutely driving nationalistic behavior in trade. And not just for minerals. Think about food, too. In 2022, something like 23 nations put restrictions on food exports to protect their own domestic supplies amid price spikes and uncertainty.
Wow. Okay, so you add up all these forces, geopolitics, supply chain fears, tech nationalism, climate, and resource competition. What's the cumulative effect? It sounds like we're drifting towards regional blocs.
That's exactly what it looks like. Instead of one big integrated global market, we're seeing the emergence of maybe multiple, somewhat separate trading zones. You can imagine, say, a U.S.-centered bloc in the Americas, a China-centered one in Asia, maybe a European sphere.
And that's where that buzzword friendshoring comes in, right?
Yeah.
Trading more with countries you trust politically.
Exactly. Prioritizing trade and investment with allies, with countries perceived as reliable partners. And the data shows this happening.
Like the shift away from China for U.S. imports.
Yeah, that's a prime example. China's share of U.S. imports dropped from around 22% in 2017 down to about 13% in 2024. Huge shift. And who picked up the slack? Mostly Mexico and countries in Southeast Asia.
Okay. And regional trade deals are reinforcing this.
They are. Things like the RCEP agreement in Asia or the U.S.-led Indo-Pacific Economic Framework, IPF, they tend to solidify these regional patterns. So the key takeaway here isn't that globalization is dead or reversing entirely. It's more like it's evolving. Some call it slowbalization, others reglobalization, meaning trade continues, maybe even grows in some areas, but it happens within tighter circles of trust. It's more fragmented, more regional, and often it comes at a higher cost, because you're not just optimizing for efficiency anymore.
Right, you're optimizing for security and trust too. Okay, it's one thing to talk about these big macro trends, but how does this reshuffle actually look on the ground? Like in specific industries, let's maybe zoom in on a few key ones. Semiconductors seem like a good place to start.
Definitely. Chips are critical. Right now, Taiwan produces over 60% of the world's semiconductors, and crucially, about 90% of the most advanced ones.
90%, that's huge concentration.
It is. And that concentration is now viewed as a massive strategic vulnerability by many governments. So what are they doing? Pouring billions into building domestic chip factories, fabs. The U.S. Chip Yes is funding fabs in places like Arizona and Texas. Europe's CHIPS Act aims to double their global market share to 20% by 2030.
And China.
China's racing for self-sufficiency too, especially in slightly older, mature node chips, though they're pushing hard on advanced ones as well. So the picture for, say, 2040, probably a less Taiwan-centric chip world. more distributed production.
But maybe also a divided one, like different tech standards or levels.
Quite possibly. You might see a sort of bifurcated system, China mastering mid-level chips for its sphere, while the U.S. and its allies focus on the high end. But the key insight, national security is now explicitly baked into the cost of every silicon wafer. It's fundamentally changing the game from pure efficiency to this mix of security, resilience, and cost. And those new fabs, they're generally more expensive to run than the ones in Asia.
Okay, what about critical minerals and batteries? You mentioned the new oil, similar story of concentration risk.
Very similar. Take cobalt, essential for many EV batteries. About 70% comes in the Democratic Republic of Congo and China. It doesn't mine that much lithium or rare earths itself, but it dominates the processing stage. It refines most of the world's supply.
So again, governments are trying to break that dependency.
Absolutely scrambling to diversify. You see the U.S. fast-tracking permits for new mines? The EU striking partnerships with resource-rich countries, Japan and Korea investing heavily overseas. And then there's policy, like the U.S. Inflation Reduction Act, the IRA.
Right, the EV tax credits.
Exactly. Those rules basically say, starting in 2025, to get the full tax credit, EV batteries can't have critical minerals sourced from foreign entities of concern, which mainly means China and Russia.
So automakers have to completely rethink their battery supply chains. Fast.
They have no choice if they want those subsidies. It's forcing a massive overhaul. So by 2030, the goal is to have much more localized EV supply chains in North America and Europe, from mineral processing right through to battery assembly. The potential implication here, we might even see something like a green OPEC emerge, a cartel of critical mineral exporters trying to exert influence, just like oil producers did. It could really change resource geopolitics.
Okay, another sector that felt the strain during the pandemic, pharmaceuticals and healthcare. We relied heavily on overseas production, didn't we?
We absolutely did, particularly for APIs, active pharmaceutical ingredients. Those are the core components of drugs. For the U.S. market, about a third of the facilities making APIs are in just India and China.
Which, again, post-pandemic looks like a big vulnerability.
Exactly. It's now framed as a national security risk. What if supplies get cut off? So policy shifting here too. In 2025, the U.S. brought in steep new tariffs. 25% on APIs from China, 20% on those from India.
Trying to incentivize production elsewhere, closer to home.
That's the idea, pushing for alternative suppliers, ideally more production in the West, especially for essential generic medicines. The insight here is a clear move away from that hyper-efficient, just-in-time global model for pharmaceuticals towards something maybe sturdier, more regional.
But likely more expensive again.
Potentially, yes. Consumers might face higher drug prices down the line as the cost of securing those supply chains gets factored in.
Let's touch on EVs and clean tech more broadly. China's got a big head start in batteries, solar panels.
Huge dominance in certain areas. But Western governments are determined to build their own capabilities, driven by climate goals and industrial policy.
So policies like the IRA are key here too.
Absolutely central. Take the EV rules again. By 2029, essentially 100% of an EV's battery components need to be made or assembled in North America to get the full U.S. subsidy.
100%. That's a massive shift.
It's huge. And it's triggered this wave of investment in building battery gigafactories across North America and Europe. The vision, really, by 2040, is for EVs sold in the West to be largely made in North America or made in Europe. It's sparking regional industrial competition on a scale we haven't seen in decades.
Okay, one last sector, maybe an obvious one given the geopolitical tensions. Defense and aerospace?
Yeah, this is a big one. With conflicts flaring and tensions high, global military spending is soaring. It hit an all-time high in 2024, something like $2.7 trillion.
Wow. And that means more domestic production.
Almost certainly. Governments are increasingly insisting that the tanks, the ships, the jets, the ammo they need to be built on home soil, or at least by trusted allies. We're seeing allies coordinating more closely to build secure defense supply chains, tightening export controls on any tech that could have military uses.
So by 2040, we might see distinct defense industrial blocks.
I think that's highly likely. It signifies this fundamental reprioritization of national security within manufacturing, moving away from purely commercial considerations in many strategic areas.
Okay, so with all this reshuffling, this move towards regional blocks and prioritized supply chains, inevitably there are going to be winners and losers. Who seems to be coming out ahead in this new landscape?
Well, one clear group of winners seems to be certain emerging markets. They're often called the China Plus One beneficiaries.
Meaning countries that companies move to when they want to diversify away from China?
Exactly. Think countries like India, Vietnam, Mexico. They're attracting a lot of new manufacturing investment. Apple, for instance, now makes something like 7% of its iPhones in India. It was near zero just a few years back.
And Mexico's benefiting from proximity to the U.S.
Hugely. Mexico's share of U.S. imports jumped from about 13% in 2017 to nearly 16% in 2024, directly picking up business that might have previously gone to China. Some analysts are even talking about a kind of India, Mexico, Southeast Asia versus China realignment in manufacturing.
Because they're seen as safer, more reliable alternatives.
Right, either geopolitically aligned with the West or at least seen as neutral, reliable partners. Places like Eastern Europe could benefit too, and resource-rich countries that align themselves strategically like maybe Indonesia, Chile, Australia.
What about developed nations? Are there winners there too?
Yes, definitely in specific areas. The U.S., for example, is seeing a bit of a mini manufacturing boom thanks to all this industrial policy, those new chip fabs, the EV battery plants we talked about.
So government policy is actually creating jobs and investment at home.
That's the goal, and it seems to be happening to some extent. And key allies, Canada, Australia, Japan, South Korea, they also benefit from being inside that trusted network, getting preferential access or investment.
And the defense sector you mentioned.
Oh, absolutely booming. Major U.S. and European arms manufacturers have very strong tailwinds right now, with exports soaring as countries rearm. So yeah, if you're a geopolitical insider in one of these emerging blocs, or if you can provide a reliable substitute for something that used to come from China or Russia, you're likely on the winning side of this reshuffle.
Okay, but every reshuffle creates losers too, or at least relative losers. Who faces the biggest challenges here?
Well, the big question is what happens to the countries and companies that were most plugged into hyperglobalization? China, for instance. While it's obviously not going to disappear from global trade, its role as the undisputed factory of the world is eroding, at least at the margins.
So its export growth slows down.
Exactly. Its share of global exports probably peaked around 2022 and is expected to decline somewhat. Foreign investment is becoming more cautious. The IMF even cut China's 2025 growth forecast down to 4%, partly due to these trade tensions and the sort of quasi-tech embargo it's facing.
And what about developed economies that really thrived on the old model? I'm thinking maybe Germany, parts of Europe.
Yes, they face significant adjustments. Germany's economic model, for instance, was heavily based on exporting high-value goods globally and importing cheap energy, especially from Russia. Both pillars are now shaky.
And European companies see this coming.
They do. Surveys show something like 90% of European industrial CEOs see this decoupling, this fragmentation, as the defining challenge of the coming decade. But here's the worrying part. Only about 40% feel their companies are actually prepared for it.
That's a big gap between seeing the problem and feeling ready for it.
It is. And that lack of preparedness, combined with higher energy costs now that cheap Russian gas is gone, could really impact European competitiveness going forward.
And you mentioned earlier, maybe the ultimate loser in some ways is the consumer.
In a sense, yes. Because this whole shift, prioritizing resilience, security, regionalization, it tends to push up costs.
Yeah.
That 1.7% average inflation impact we talked about, that's consumers paying for it. And the IMF is pretty clear. While everyone might feel it, it's likely low-income countries and poorer households within rich countries who will be hit hardest by rising prices for basic goods.
Right. Okay, so this is a huge macro shift with big implications. For businesses, for investors, it clearly presents massive risks, but maybe also some incredible opportunities. If you're trying to navigate this fragmented future, what kind of strategies should you be considering?
Well, one massive area is simply building the new infrastructure needed for these reorganized supply chains. Think about Mexico estimates suggest it needs something like $400 billion by 2032, just for ports, railways, roads, and energy grids to handle all the new manufacturing activity.
So huge opportunities in construction, engineering, industrial real estate.
Absolutely.
Yeah.
Companies involved in building and equipping these new factories and logistics networks are likely to do well.
And you mentioned defense and security earlier.
Right. Defense contractors clearly have strong tailwinds with global military budgets rising. NATO countries are talking about spending 3.5% to 5% of GDP on defense by 2035. That's a huge increase. Cybersecurity is another massive growth area as digital connections become potential battlegrounds. And maybe some investors look to traditional hedges, like commodities or precious metals, like gold, during times of heightened geopolitical stress.
What about the energy transition? That seems tightly linked to this whole story.
Incredibly linked. There's massive investment flowing into renewables, battery storage, upgrading grids, and of course mining those critical minerals. The IEA estimates the mining sector alone needs between $360 and $450 billion in investment by 2030. Policies like the IRA are pouring hundreds of billions into clean tech manufacturing. It's really igniting a whole new industrial cycle in some ways.
So investing in companies involved in that transition. And what about directly investing in those winning regions or the friendshoring theme itself?
Yeah, that's another angle. You could look at country-specific ETFs for those potential beneficiaries like Mexico, India, Vietnam, or there are now thematic ETFs emerging that explicitly try to capture the reshoring trend, investing in companies likely to benefit as manufacturing moves closer to home.
Okay, one last area. If companies are moving production back to higher cost locations like the US or Europe, they'll need to manage those costs, right?
Absolutely. Which means they'll be investing heavily in automation, robotics, AI, and sophisticated digital supply chain management software. So companies providing those technologies, the ones that help make reshoring economically viable, should see strong demand. Industrial software, AI-driven logistics platforms, automation providers. That's another key area to watch.
This is fascinating. To help us visualize how this might unfold, maybe we can quickly walk through some potential milestones between now and 2040, just to get a sense of the trajectory.
Sure, we can sketch out a possible timeline based on current trends and policies.
Okay, so starting right around now, 2025, what should we be looking for?
Well, expect global trade growth to continue lagging behind global GDP growth. We'll see those high U.S. tariffs really biting. The EV tax credit rules kick in fully, disqualifying batteries with Chinese minerals. And critically, this might be the year China's share of global exports actually peaks and starts a gradual decline, while places like India and Vietnam see record FDI inflows. That signals a real shift.
Okay, jumping ahead a few years, maybe 2027, 2028.
By then, we should see the first big wave of those EPS Act-funded semiconductor fabs coming online in the U.S. and Europe. It won't end reliance on Asia overnight, but it's a start. U.S. EV battery rules get even stricter, requiring maybe 80% or more content from friendly sources. And sadly, we might see the World Trade Organization become increasingly sidelined, kind of toothless, as major economies focus on bilateral or regional deals instead.
Right, looking out to 2030.
2030 is a key date for many climate and industrial policy goals. The EU hopes to hit its 20% global chip share target. Critical mineral demand is projected to roughly triple from today's levels, which could cause real shortages and price spikes if supply doesn't keep up. Also, a big demographic shift. India's workforce is projected to surpass China's in size around then.
Wow, okay, further out, maybe 2035.
By 2035, global trade as a percentage of GDP could potentially fall back to levels we last saw in the early 2000s, before the peak of hyperglobalization. That ambitious NATO defense spending goal of up to 5% of GDP for some members might be coming due. And maybe, just maybe, we start seeing the early signs of parallel financial systems operating perhaps a digital yuan-based network, gaining some traction for trade settlements outside the Western SWIFT system.
A truly fragmented world, potentially. And finally, looking way out to 2040.
By 2040, critical mineral demand could be 4 times higher than today. Climate change impacts droughts. Floods will likely be severely reshaping agricultural trade patterns and driving food protectionism. India could plausibly be one of the world's top 3 economies by then. And it's conceivable we could see regional reserve currencies gaining prominence, maybe a more tripolar currency world alongside the trade blocs, and perhaps even distinct technology stacks emerging, making global scientific collaboration much harder.
That's quite a trajectory. So just to recap then, this deglobalization we're talking about, it isn't necessarily a complete collapse of international trade, is it? It's more like a strategic redirection.
Exactly, a reorientation. The world of 2025 to 2040 will still be interconnected, maybe deeply so in some ways, but it'll be less uniform, more selective, more clumpy, perhaps.
Right. And the core shift, as you put it, is moving away from an era obsessed with maximal efficiency, above all else,
Towards an era defined more by seeking stability and resilience, even if that comes at a higher cost. And the companies, the nations, that figure out how to balance those competing priorities, efficiency and resilience, they're likely the ones that will lead the next wave of growth and really shape this new economic landscape.
So as we wrap up, the big question for you listening is, what does this all actually mean for you? As we look out towards 2040, will this great global reshuffle make the world safer, more self-reliant, or will it just end up being poorer and more divided? It's worth thinking about how these huge shifts might ripple down into your daily life, the stuff you buy, the prices you pay, maybe even the kind of job you might have.
Which really brings us to the final thought. How will you adapt? How will we adapt to this new paradigm? Because the playbook that worked for the last 30 or 40 years, it's pretty clearly being rewritten.